Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It was Friday, January 9th, 2026, and the tape looked boring at first glance. The S&P barely moved, but this wasn't a sleepy session. Money was sliding out of crowded AI and chip winners and into old economy energy, defense, and select financials. With a key jobs report and a major tariff ruling still ahead, traders kept the market stable on the surface, but a lot more tactical underneath. Look at the S&P heatmap and the story sharpens. You had a patchwork board, plenty of mid-cap and smaller names in healthy green, but big, deep red boxes right where semiconductors sit. NVDA and its chip peers visually punched a hole in the tech complex. At the same time, energy lit up as one of the few uniformly green clusters, and pockets of financials and cyclicals quietly supported the broader index. That heatmap translated into a market that felt cautiously constructive, but choosier. Investors stayed in equities, yet they trimmed the most extended AI and semiconductor winners and leaned into real asset cyclicals, defense, and some banks. The Dow and the Russell 2000 outperformed. The Nasdaq slipped, and that split captured the day's tension. The bull case was still alive, but leadership was getting narrower and more rotational, not broad and exuberant. On the desk chatter front, two overhangs kept coming up. First, the Supreme Court's pending decision on the legality of President Trump's tariffs. No one knows the outcome, but traders talked about scenarios that could shift trade flows, inflation pressures, even the fiscal picture. Treasury Secretary Scott Bessent calling the likely result a mishmash only added to that uncertainty. Second, desks were also circling Friday's December jobs report. With consensus looking for only a modest payroll gain and a slight dip in unemployment, positioning stayed cautious. None of this is resolved yet, but it clearly shaped how much risk people were willing to put on today. Meta's planned acquisition of AI agent startup Manus has entered a regulatory review phase, introducing a new layer of uncertainty. The deal itself was initially expected to be straightforward, but China's Ministry of Commerce has now indicated it'll examine the transaction under rules governing technology exports, cross-border data movement, and foreign investment. Importantly, Manus being incorporated in Singapore doesn't automatically place the company beyond Beijing's regulatory reach. The broader takeaway extends well beyond this single transaction. As AI capabilities become more strategically sensitive, mergers and acquisitions in the sector are increasingly shaped by geopolitical oversight, rather than just valuation, innovation, or strategic fit. That shift adds friction, delays timelines, and raises execution risk across global AI dealmaking. NVIDIA was the clearest symbol of today's rotation. The stock showed up as a deep red block on the S&P heatmap, as traders took profits and cut exposure in one of the market's most crowded AI trades. NVIDIA's been a primary engine of the broader equity rally, so its underperformance didn't just nick the Nasdaq. It forced investors to ask whether AI leadership is simply digesting gains or starting to lose its grip on the tape. Pressure wasn't limited to NVIDIA. AMD and Supermicro both traded lower in sympathy with the broader semiconductor and AI hardware complex. There wasn't a single bombshell headline. The story was positioning. Traders backed away from some of the hottest, highest beta AI infrastructure names after an extended run, reinforcing the sense that the first place investors are de-risking is the top of the AI supply chain. On the other side of the trade, ExxonMobil moved higher alongside a broadly green energy complex. With crude prices firming and investors rotating toward real asset exposures, ExxonMobil acted as a bellwether for that shift. Its strength and the broader bid in integrated oil and gas helped prop up the S&P 500 even as semiconductor heavyweights came under pressure. Lockheed Martin was another clear winner. Defense contractors rallied after President Donald Trump signaled a desire to sharply increase U.S. defense spending. Names like Lockheed, Northrop Grumman, and L3Harris drew fresh interest, giving the market a policy-linked leadership pocket that had nothing to do with AI chips. That new narrative helped diversify where bulls could find upside. Goldman Sachs also participated in the day's rotation. The stock traded higher as investors leaned into banks and capital markets names, tying the move to expectations for healthier deal flow and a fairly stable macro backdrop. Because Goldman is a key barometer for risk-taking in the financial system, its bid supported the view that this was a shift within equities, not a wholesale step away from risk. Not every big tech name was under pressure. Amazon and Alphabet both traded constructively, showing as green anchors on the heatmap. Investors leaned on Amazon's diversified cash flow and e-commerce profile, and on Alphabet's ad and cloud franchises, which were seen as less stretched than pure-play AI chipmakers. Their resilience signaled that leadership is rotating within the growth complex, not abandoning it altogether. OKLO, one of the market's high-beta nuclear and clean energy favorites, finally cooled a bit. After a huge run on expansion milestones, the stock saw a modest pullback, with options pricing and spot quotes reflecting traders locking in gains and trimming risk. OKLO's become a sentiment barometer for speculative clean energy names, and today's pause fit the broader pattern of investors being more tactical with their biggest winners. Looking into next week, the market's playbook is pretty clear, but fragile. Traders are watching the December jobs report, then the upcoming CPI and PPI prints to see whether the soft landing narrative holds. At the same time, that Supreme Court decision on President Trump's tariffs hangs over everything, with potential knock-on effects for trade, inflation, and the deficit. If the data or the rulings surprise, today's measured rotation could flip quickly into something more directional. We end the day with a market that looks steady on the surface, but is clearly resorting itself underneath. AI hardware and the most crowded tech trades cooled, while energy, defense, and financials carried more of the load. From here, the path of travel will depend less on today's price action and more on the next wave of data and that crucial Supreme Court decision on tariffs. Expect the next session to test whether this was healthy rotation or just the first crack in overstretched themes. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.